Okay. We on? Okay. Yes, we are. Okay. All right. I think we're going to get started. So good afternoon, everybody. Thank you for coming to the panel, the lending panel today. Lending today, tomorrow, and in the future. I'm Drew Hibbert. I'm the Senior Vice President of Finance and Investments at Vision Hospitality Group, family-owned and operated hotel owner, operator, developer based in Chattanooga, 42 hotels in the portfolio. Got 4 under construction right now and another 11 in the pipeline beyond that. So we are very active in the debt markets. We're construction, acquisition, refinance. So with that, I'll have you guys go ahead and introduce yourselves and quick rundown on your respective shops.
Awesome. Scott Andrews. I'm the division executive for Wells Fargo's middle market hotel franchise finance business. We're a national hotel lending vertical and also run our U.S. gaming and casino business. Obviously, we're a relationship lender. We focus on regional owner-operators all the way up to big national owner-operators. Our brands are typically Marriott, Hilton, some IHG and some Hyatt product. Term loan lenders, 5 and 7 year transactions, acquisitions, refinances. We don't do new construction, but we will evaluate construction takeout products. So that's who we are.
My name is Bruce Lowry. I'm the Chief Lending Officer for Access Point Financial. We're a private equity-backed specialty finance lender based here in Atlanta and 100% focused on the lodging space. We're also, called mid-market. Our focus is, and maybe this is a question we may talk about later on, but we focus on 3 things: people, assets, and markets. And we're looking for people who have a significant footprint in the industry as opposed to a first-time borrower or developer. We like brands, and we do also like Marriott and Hilton, and so a lot of our portfolio is weighted for that. And when it comes to markets, we're broad across, we would tell you the top 50 MSAs is where we lend, but really what we do is take that deeper dive into what are the supply and demand metrics which make for a successful hotel project. And we do bridge loans, we've done construction loans, we do renovation reposition, we have fixed and floating, and we can do higher leverage transactions as well.
Jim Petty, Western Alliance. We have $4.2 billion in hotels. We do full service, limited select service, very little on the full service. We do term loans, construction loans. I would say really the way you look at us, as Scott touched on a little bit, we're relationship lenders. We focus on relationship. I would say that we actually got out of focusing on hotels 3 years ago. My partners and I that run the hotel group for Western Alliance mainly focus on relationships. We're very focused on relationships. So last year we actually closed $2.3 billion in hotels, which was construction, term loans, acquisitions, and refi of other people's debts. So we are very active, and again, we have $4.2 billion in the hotel sector alone. So that's what we do.
Hi, I'm Michael Sonnabend. I'm the managing member and co-founder of PMZ Realty Capital. We are a New York-based financial intermediary, and we focus 99% on the hotel space. My partner, Peter Burke, and I have been doing this together for about 20 years, over the course of which we've done about $10 billion of deals with and for most of the guys sitting up here. We do balance sheet deals, we do equity deals, we do capital markets executions. I would say in the last year or so, we did about $300 million worth of deals, of which probably 80% were with portfolio lenders like banks, credit unions, life cos, and the balance with capital markets executions.
All right, thanks. Just to sort of help guide the discussion, just by show of hands, I'm going to ask who's looking for construction, acquisition, or refinancings. So, how many people are out there looking for construction loans right around now? I am. So, okay. How about acquisitions? Okay, and then refinancings on the horizon? Okay. So, seemed like a relatively even spread. So last year when we were sitting here at the panel, one of the things that we were talking about was, we thought we had sort of more clarity into the recovery, and what was the trajectory of things, and obviously we were wrong. And so, you guys are the experts, and this is a jump ball. So what's going on?
In the last 10 days or in the industry?
Sure, you can do. I mean, because just for the sake of the audience, we were talking about 2 weeks ago before the panel, and then about 4 days ago, it was kind of like, okay, I have no idea what we're going to talk about now. So, I mean,
high level, I think the industry fundamentals are still good, right?
Yeah.
As far as RevPAR goes, since COVID started, we track the RevPAR recovery of every hotel that we have on our books by month, and the whole portfolio, other than maybe a couple assets, are well above where they were in 2019, which is great. And in the last 10 days, it's certainly going to probably result in some tightening of credit potentially with lenders. Spreads might widen a little bit, but everybody that's up on this panel still has access to capital, and still it's what we do day in and day out, right? Everybody up here. So if we were generalists, I think our banks would say, hey, let's ease off of some of this commercial real estate, but we're not. So that's kind of what we focus on. So we're still all lending money. We're probably going to be strategic and good stewards of our capital for our shareholders, and that's kind of where we are.
Okay.
Yeah, I think I would add to that. I think when the last 40 days, and talking to Tanvir that works with me here on the front row, we were talking with some of our analysts, and you look at a deal and you say, okay, well, the covenants are getting a little tight, and where I was having a discussion with some of our guys is like, wait a second. If the hotel is performing better today than it was in 2019, we don't have an asset problem, we don't have a relationship problem. The hotel is performing well. What we have is an interest rate problem. And as the interest rates continue to go up, I'm not clairvoyant, I was just trying to solve for a problem a month ago. So obviously that's putting stress on it. With some of the things that happened with other banks in other sectors, I think they were too focused on singular things. Scott's very well diversified in their wealth portfolio. We're very diversified in ours. So I think there is going to be a tightening. But as I've said, the last 4 years I've been on this panel, it seems like 5, but maybe 4 years. The last 2 years has been interesting.
Yeah.
Or the last 3 days has been interesting. I think I've always said, guys, you need a good relationship with your lender. If you're listening to the panels before this one, Ben Brunt said, you need a good relationship with your lender. And I had 6 people come up to me after the thing last year and said, hey, can we start a relationship? I said, sure, as soon as I take care of my 15 customers, my 15 current relationships. So I think what this disruption is showing you is get 2 or 3 good lender relationships. That's what you need to focus on. And even if you don't do a deal with them today, strike up the relationship, because you don't know when you're going to need them. You don't know when the Fed's going to correct or do whatever. So again, that's why I had my introduction and I said, we're relationship lenders. And Scott does the same thing. He's a relationship lender. So that's where I would say that I think the industry's going. You better partner with your lenders that you know that can provide some good partnership with you in the future. And in addition to that, be a good partner to your lender.
Right.
So,
Bruce, were you going to?
I was going to say something very similar, that the challenge for us as speakers is we're asked questions that have a macro basis to them. Yes. And it was reminded when you asked the question that you can drown in a river 6 inches deep, which is a way of saying that to have the macro view that there's a tightening of credit, and which seems certainly likely, is going to make it more challenging. But I think if you listen to the advice Jim just gave, which is where I would have gone with this, is that it's really important to put your best foot forward. And so I'll just maybe riff off that a little bit. I got a request the other day that had basically no information. Will you finance this construction loan of a XYZ brand, but nothing about the owner, nothing about the property, nothing about which of the flags within that brand it was. And that's boom, that deal's dead.
Yeah.
And we're not looking at it again.
Well, that wasn't really even a deal. That was an email. You know, it's not a deal
Yeah.
if you don't get information that you need to even know what the brand name is.
Right,
Right.
right. Well, and that also speaks to the sponsor, right? Because I mean,
Yeah.
if they're not forward thinking enough to be able to say, hey, here's the package. I mean, you know, that's probably not somebody you want to deal with anyway.
You don't want to deal with them, and so
Right.
you're self-selecting out. And so
Yeah.
in a time where credit is tightening, it is more important than ever to be very, very professional about how you approach lenders and show that you're thoughtful, show that you are professional, so that you really work through it. Because we're in opportunities like this, we're going to get more inflow than we normally do because there's going to be fewer capital sources out there. So that's my advice to you.
One of the topics I heard before, I apologize, is over-communicate. Over-communicate. One of the panelists that works for Hunter, her advice was get in early, get in often, send them more information, over-communicate, and which is what Bruce just said, and I think it's very poignant.
Well, I think there's a couple things. It's a good time to have a good intermediary to help you because as one door closes, there's a lot of capital out there. It's just coming from different sources. As was mentioned, the performance of the majority of hotels is significantly improved.
Yes.
It's above where it was in 2019. It's not an asset problem like you mentioned. It's just a interest rate problem. It's a problem that there's in the banking sector, they're having issues that may or may not have anything to do with hotels, which cause constraints. But there's a lot of other capital in the market. The terms and conditions may be a little bit different, but you need to know where to find it, and then you need to figure out how to make your deals work based on the framework of what's going on today. We've got a lot of people who call us and say, well, I just want what my bank used to give me. Okay, I'd like to have more hair like I had when I was 30. So it's an issue of you have to have realistic expectations to be able to work in today's environment, and I think that's helpful to get deals done.
Got it. And so speaking of that, I mean, so Jim, for example, to you, realistic expectations. So where are you sizing stuff on a leverage-wise these days?
So here again, I think if you go back 60 days ago, we're actually, well, back up a little bit. So last year when we were sitting in here, we're like, what's the recovery going to look like and what are we going to do? If you go back before last year, our biggest year in production was $1 billion. We closed $2.3 billion last year. So we were running and gunning and doing everything, which is great, but we have to digest that. So when we were looking at underwriting, you're getting to the point you're having to underwrite a deal at 8.5%, and then you're kind of looking at good fundamentals and kind of going from there. I think today we're going to continue to look to underwrite probably in that 8. You're very focused on debt service, the understanding that interest rates will come down in the future. By the way, that was not a tell. I do not know what's going on in the Fed meeting later today or the rest of the year. But they will continue to come down, and as RevPARs continue to stay steady and then grow from there, I think that's what we're looking at. So we're not focused as much on debt yields, but more debt service, which I think is a more telling deal. We're typically 55 to 65% loan to value. But again, our partners that we partnered with for the last decade, if not longer, you know, those are the deals because we have a good relationship. They over-communicate with us, and we know them very well, and they know us very well. Those are the deals that we're really focused on in the near term.
Got it. And so just to distill that down, you're sizing loan proceeds on debt service at an 8% or 8.5% interest rate. So,
you know, I think when you look at it, yes, the short answer is yes, but we also look at a debt per key, cost per key. You have to keep the fundamentals sound and behind you because this interest rate environment, this too shall pass. So, you know, sooner or later you're going to get back into fundamentals. But if you did the same thing when interest rates were 3%, lenders got in trouble. They did, because there was an abnormally low interest rate. So there'll be some changes in the future, but you know, it's basic X's and O's. If you're a football fan, it's just basics. Get to the basics, price per key, debt service, debt yield, continuing, and make sure you have the right partner with the right flag.
Got it. And
Would you
so,
say that why you've gone away from debt yields is because in a 3 or 4% interest rate environment, you had what looked like a strong debt service cover was a low debt yield, but today with your 8.5, you're looking at that debt service cover, and that might be higher than your old debt yields.
Well,
Is that
yeah,
the
so
case?
debt yields are a little deceiving sometimes, right? I mean, it depends. They can be, impacted, but if you get down to cash flow, cash is king. I'm not sure what T-shirt said that, but cash is king. So, that's what we focus on.
So
Leverage.
show me the money, Lebowski. That's what it was.
I'm not a big Lebowski fan. Oh no, that was
that's Jerry Maguire.
There you go.
Jerry Maguire.
Show me the money? Yeah.
Yeah.
Dude, you're on the wrong movie.
Yeah.
Okay, well, Lebowski.
But the rug really tied the room together.
Up your
so-
meds, baby.
Yeah.
Up your meds. Come on.
Yeah.
It'll be all right.
So, all right, so talking about, relationships, Scott, for you, Wells Fargo, what is your sort of ideal borrower look like? What are they coming to the table with? What are they asking for? Where can you guys be the most helpful?
Yeah, so I would say it's at least a 10 asset operator, preferably in the brands that we finance. It is majority Marriott and Hilton, but we do some IHG and some Hyatt. And so we're seeing a lot of maturing CMBS debt, well-performing properties that they have to find a home for them. And our cost of funds are better than what Jim's quoting. So the numbers work. I mean, we're probably in 675 range for a 5-year fixed rate transaction, which is roughly 300 over the 5-year treasuries today, ballpark. So that part is nice as well, but it's really people. It's people that have been in the industry. They've been through multiple real estate cycles. They feel this one, but hey, it's the 5th one they've been through, right?
Right,
So
right.
this too will pass.
Yep.
Interest rates will drop. And to Jim's point, historically debt yield was everything when you underwrote commercial real estate. It's still a key metric because it does take away interest rate, takes away appraisal, takes away amort. You can do a lot of stuff to manipulate DSCR with interest only, but it does come down to cash flow right now because I looked at a 4-pack acquisition the other day, and the initial book said they want 65% loan to cost, loan to value, which we can still do that in our world, assuming that cash flows right. And I had to ratchet it all the way down to 50%. And it still didn't meet our DSCR covenant. I was like, that's not a deal like for us. So, so we do look for more center of the fairway properties that have good credit metrics. With that, we can put a good interest rate on the deal as well. We are non-recourse, as Jim is, ability to do non-recourse balance sheet financing, which is unique in our world. Most banks are going to require recourse. If the property is still stabilizing, like we do some construction takeout properties at C of O with our experienced relationships and sponsors, those we will put like a 25% recourse on there and then give them a path to burn that off as soon as it's stabilized. So it really just comes down to having partners that are in the industry. They've demonstrated success over multiple real estate cycles, and you can trust them. And you're financing the right brands in the right markets.
And I would add to that, the reason Vision does so well, and you guys have done so well, you have a 20-year track record, if not a little bit more.
26.
Potato,
But who's
potato.
counting?
Potato. I was directionally correct. So 20 plus years, and you have a track record of the cycles, and you can point to your book.
Right.
And when a lender visits you, you say, hey, our portfolio is X. Our debt service on the entire portfolio is this. We've never lost money. We boom, 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 boom. And the lender goes, shit, let's have lunch. I think we can wrap up the loan later. So that's a good thing.
Yeah.
Over communication.
Sorry?
That's over communication. That's good.
So, Bruce. So you guys cover a broader swath of product, right, than what we're talking about right now. So where are you seeing the most demand right now in your shop?
So define broader swath first. We love cash flowing, stabilized properties, but it's tough for us to compete with bank cost of capital. So we are comfortable looking more pro forma and taking unstabilized properties and going through a value creation or brand change or PIP or whatever it is, and getting to a stabilized, underwriting that stabilized number. So broad swath for us to be is, we're open to those value creation stories. Why is property X that's not meeting its debt service cover, that doesn't have an attractive debt yield or, even good cash flow, how are you going to move that to brand Y? And what's that capitalization? So we're going to look at the total capitalization of a deal. We're going to underwrite the same way everybody does. But that's why we have a broader swath. So where we're seeing a lot of that. When I was having a conversation just before this, and we were talking about if there's a credit crunch and you have roughly, 15 billion of hotel CMBS coming due this year, 250 billion of maturing general commercial real estate loans. And if you add in the CMBS loans that already are extended and now due this year, that number's more like 28 billion. That's just CMBS. The average duration on that's probably become over 10 years. You've got a PIP that is inevitably due. Guest satisfaction scores are declining in the industry. The ability of everyone in this room, when you are not an owner or in the industry, but you're a guest, you're looking for high quality stuff, right? You are paying more at a higher rate than you have in a long time, if ever, and you want to make sure that you're getting a bang for your buck. So extend and pretend from lenders who, in time of credit crisis, is a pretty proven playbook. And the brands are not really incentivized for kicking you out of the system for not doing the PIP. But there comes a point when the rubber meets the road, and I'm curious if we are there, where the lenders are facing fatigue because they've gone through COVID, they've gone through this ramp-up period, and the industry owners, have used your FF&E reserves to keep debt service current. The brands have been very forgiving about requiring upgrades, but there's a confluence of events, and there's no one answer here, because it's going to be just what we were talking about before about relationships. It's about the power of your relationship to drive change and to make it work. But it's in environments like this that is very opportunistic for us.
I would think.
We really, not want to take advantage of anybody's misfortune at all. But this is what we do.
I think a number of properties, I talked to an owner today, is going to list 6 or 8 of their properties because they don't want to do the massive PIP. Just come and do it. They just rather sell it and let the next guy do it.
Yeah, right.
But if you equate this back to 08 and 09, where the large banks and the CMBS and everybody was creating, and you had the same stuff coming to market or maturity in the last 2 years, that all got worked out. This isn't a bank crisis. This is some liquidity in the system based due to very quick rise in interest rates. Asset qualities are good. Hopefully it's not a pretend and extend, but hopefully there is some workaround. And fundamentally, when we sit here next year, maybe there's some different avenues and some different funds and some different things that have come into play. If you looked at COVID or prior to COVID, there were some hotel brands you're like, I'm not really sure that works. And then you had Margaritaville roar out of the gate and become one of the predominant, staycation or single, go there and destination deals, where we're a big fan and we have a couple of them in our portfolio. So times will change, things will evolve, but good quality operators with good locations, with good partnerships throughout their lender and throughout their entire group will survive and will thrive. And then you'll have that track record and you'll expand and grow.
Right.
But there's a big difference between now and 2008 or 9.
Yeah.
The fundamentals of the property
Are good.
Yeah.
So
Right.
that's going to attract capital.
That's going to attract capital.
We've done lots of deals with different capital sources that have been attracted to this mix.
Well, to my point, I think there will be additional sources that
Yeah.
maybe not know today. Not
comparatively
to sound like a
yields.
salesman, the glass is half full, if not full, but not to be a salesman.
And it
Yeah.
can always be refilled. There's
It
somebody.
can always
there.
be
Well,
refilled.
I mean, look, you know, I was just telling Scott, I mean, just, you know, relative to other real estate types, the yields in lodging and hospitality are tremendous when you look at it relative to
You're above
industrial.
2019.
Yeah, and then, you know, the other thing is like, you know, all right, who's, you know, how much capital is out there for, you know, Class B, Class C retail, Class B, Class C office. You know, you've got a product type that is resilient, robust, inflation resistant, you know, has a track record. So yeah, I would think that you're going to be seeing a lot more capital flowing into the space. Michael, one for you. So when I've worked with your shop in the past, you know, it's been pretty much all CMBS, right? And so going into COVID, we had 18 CMBS loans, and I cursed every one of them, right? I was just like, this is the worst thing ever. We're never doing this again. Da, 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 da. You know what? Those CMBS loans, like, I would say 75% of them are sub 5. They're all sub 5. Right. I've got a couple that are sub 4 that I did with you guys. Right now, I love those loans. Right? They're fantastic. I got 6 years. I still got, I still got 6 years on the term.
It's too bad we didn't do a 20-year
I'm sub
loan.
4. Yeah. So I guess the thing is, it's like, I swore I would never do another CMBS deal. Well, yeah, right. I'm probably going to do another CMBS deal at some point.
How was the flexibility during COVID?
It was absolutely horrible.
Well, but
that's cursing.
You bring up a great point. If you're a 40 hotel portfolio, don't just come see Scott. Don't just come see me. You need a mix of floating, fixed,
right.
longer term. If you have trophy assets, now I've had buddies that had the CMBS, and the first of the month, they freaking cursed every time they had to write the check. Or pay $20,000 to have a lunch with the servicer.
Right.
I get it. Some of y'all had those lunches, sorry.
Yeah.
I get it, but to your point, 4% right now would feel pretty damn good.
Well, and the thing too is, I mean, there's an accretive piece to that in the value, because whenever we talk to a broker, CMBS used to be a huge liability when you were going to sell a deal. Sure. But if I've got, I don't know, 60% LTV on a CMBS note that's got 6 years of maturity on it, and I'm at 410, that looks pretty good to a buyer,
not so bad,
right?
Yeah,
so
that
Michael, back to you. I mean, so where's CMBS world right now? What are you guys seeing? What's going on?
So just to touch on what you said, over the years, a lot of times the clients would say to us, well, I'm just going to go to my local bank, because then when something bad happens, I have someone to talk to. So not these gentlemen, but when the world kind of went bad with COVID, some of them went to talk to their smaller banks, or even some larger banks, which are no longer on their own, which have merged with other banks. They went to talk to their banker about the deal, and they said, I'm sorry, you need to go talk to Stonehill, or you need to go talk to some guy in California who we sold all the loans to, so that didn't really help at that point. But what we're seeing today, things ebb and they flow. So last year, we did lots of deals that were floating rate deals with life insurance companies or other portfolio lenders, because CMBS rates were too high. So nobody wanted to lock that in. Nobody wanted to have a 10-year deal. They couldn't really do a 5-year deal, so we did that. Now, it's kind of come a little bit full circle. We just are in the process of closing a $35 million deal in Orlando. That's a Hilton product that we started out. The borrower said, I want to own this for 3 to 5 years and then sell it or do something. So let's go find a floating rate interim loan. Okay. So we go out and we go through the marketing. We include some CMBS lenders in it. We got a bunch of quotes from floating rate balance sheet lenders who wanted to do a 3 to 5 year deal. And they had a cash out, and there was some other stuff, and it was 8 to 10% plus fee. They didn't really like cash out, so that was one set. And then we said, well, how about, I know you don't want to do a CMBS loan, but here, would you like to borrow at 7.25% for 5 years, fixed? There's no fees going in, and they'll give you your cash out of the deal. And they said, okay. We said we would never do another CMBS loan, but I guess never is a long
Never
time.
came early.
Never have
Right.
a drink.
Yeah.
So now we're seeing a lot of activity with interest rates have dropped, right?
Yep.
Through bad things happening, sometimes good things happen along with it. So now that the fact that treasuries the rates have dropped, we're now in the process of doing a group of CMBS loans that are kind of vanilla 10-year deals. The best deals are getting fixed rates of around 6.5% for 10 years. Other deals are we're up to like maybe 7% if they want to do a 10-year deal. If they want to do a 5-year deal, somewhere around 7%. But I think that's a cost of capital that's a lot better than people saying, okay, I don't want to lock in for 8.5% for a long period of time. That doesn't work. But over the years, we've all done lots of deals at 6.5% or 7%.
Well, and
they're not all. You had great timing and did all those deals with us at 3.5% or 4%, but not everyone had that great
Right.
timing.
Well, and the thing is too, is that the rates you're quoting are non-recourse rates.
Right.
And there's cash out,
Yeah.
which is huge if that's what somebody's looking for.
Right.
The moral of the story is never say you won't never do anything
I know.
again.
Yes.
Right.
Out loud.
Yes.
Well,
Or on a
think
panel.
it, just don't say it. No, to your point, historically, a 5.25 rate, everybody's like, hey, done.
Yeah.
But sometimes you're below that, and you got to lock that in. Sometimes you're above that. You just need to get through that. The one that he said, though, with dealing with some of the community banks, I wouldn't deal with a small community bank. I would deal with one of the 4 guys up here that know how to spell ADR and know what a rep par is. Because if you have to
How do you
educate your
spell
lender on
ADR?
what ADR is, you probably need to leave the office and get on the internet and find somebody that actually knows what that
Well, we did a deal with a credit union, and we're in the middle of closing, and I said, oh, do you want a comfort letter from the, they said, what's that?
It's
You're
a
like,
big
nothing. It's
blanket.
nothing. Don't worry.
We explained what it was, and they said, that sounds like a good idea. And to this day, IHG said it's the only comfort letter that was ever, had no negotiation.
You know that sends
Yeah.
chills up my spine right now.
Michael
It
brought
is
up a good point before with some of the banks and relationship lenders. You should ask your bank, do they sell your loans? Like we portfolio manage and maintain all of our loans. So does Jim's group. So that's really important.
Yeah.
Well, and
that is a good
you're
point.
much less likely to do that than, as Jim said, a community bank that says, oh, we just don't want to be involved
Yeah.
in this.
Right.
Yeah.
Got it.
Or the need to syndicate a loan, right?
Yeah.
Yeah, that's,
Yeah.
we're not interested
Because that's
in
always
that.
fun. So, and we see that a lot more on the construction side, of things. And because, in our experience, we typically go to the local guy to get a construction deal done. And they typically tend to be smaller, and their in-house limit may not be enough to cover our deals. So, yeah, I mean, we've had stuff where we've gone out. I mean, Danielle's sitting here, and she's had to suffer through, trying to go find participant banks on construction deals for us. And it's just like, it's just a drag.
But there are some groups in, smaller towns that are like, hey, we already got 4 guys lined up.
Yeah.
If you need 20 million, when we tee off tomorrow at 2, we'll make sure everybody's in for 5, you got your loan, which is great. I think that is a great source and community driven, and that's great. Now, when you get it built, you want to term out and you want to do something longer, I'd probably talk to one of the guys on this panel.
For sure. Bruce, can you give us a rundown on the last great deal you guys closed?
Well, the last great deal, if you fast forward 24 hours, we'll close on $20 million, just short of a $20 million loan in a Hilton Garden Inn in Tampa. It's acquisition. There's a PIP associated with it. It's a very strong sponsor. They actually brought in some institutional equity.
Great market.
On the backside, made it stronger. So when we took it in underwriting, they weren't there, and we were comfortable and got a 40% institutional equity partner. And it's going to be a fixed rate deal. It's 75% leverage. There's a not insignificant PIP that's going to go along with this, and 5-year deal, call protected, interest rate in the upper 8s. But I'll answer the question a little more broadly. So this time last year, I may have said in this panel that I expect all our business will be fixed rate refi. And last year, by a long shot, most of our business was floating rate acquisitions. So really surprising. So, I'm not going to make any prediction about what the mix is going to be this year. But it's important for us, what we do is we don't think about products. We think about capital solutions for borrowers. So you're selling with assumable 4% rate. And this person, I can't do a second, I can't do a mezz because that CMBS lender won't allow an intercreditor agreement. I could do pref equity to provide a little more leverage in there.
Right.
You have a bank loan that you can get an extension on with the condition that they do the PIP, but the bank's like, we're tapped out, it's got to be equity. Well, we can do an FF&E CapEx loan behind that. There's some complexity there, but generally, so we're providing capital solutions is how we think of the opportunity. Within that subset of what we call the 5 and 5 rule, the 10 and 10 is maybe we're directionally in that way,
Right.
but the shorthand elevator pitch is with 5 and 5 rule. 5 years in business, 5 like-kind hotels. So with that as a starting point, let's find a way, can we work together to help you put your capital stack together where we're the 100% piece or a portion of it.
Yeah.
Got it. And so, sort of riffing off that a little bit, so Scott and Jim, you guys were both talking about, it's cash flow, right? It's about looking at the cash flow. So how are you arriving at that now? Are you looking at a T12? Are you looking at projections? Are you looking at 2019? I mean, what's driving your underwriting?
I mean, the easy thing is a T12 on today's rates, but if you see rates continue, if you fix it, that's where it is, right? But if they're floating and putting a cap on it, you still got to underwrite to a little bit of still increase in Fed funds potentially. But I do think we're at 90% of where this thing's going to top off. Like, 6 months ago, I'd have given you a different answer, right?
Well, and we're going to get there in just a second.
6 minutes ago,
Exactly.
you gave a different answer.
So, but yeah, if you can, we pretty much have to hedge everything that we're doing right now. So if it's floating, it may not be 100% hedge, but you can put collars on it, you can put a cap on it, we can fix it for the full term. So just has to have some sort of a hedge on it.
Got it.
Yeah.
And so, Jim, same question to you. Are you guys, how are you getting at cash flow as far as your underwriting?
So I think it gets back to the basics. We look at the TTM, and then you do compare it to 2019. And is there runway? Is it up or over 2019? You look at the projections. Some of the deals we've looked at lately were some value adds, and they kind of really ramped up over the next 2 years. So you're like, okay, but I don't know that I can underwrite to 90% occupancy. We're probably going to still be in the 78% occupancy. So we do temper them a little bit, but I've always been a great fan or a big fan of TTM. I think that takes some seasonality out of it, and that really kind of focuses. I do think that 2009 was a historic high for everybody, and that's what kind of everybody uses the measuring stick. If it's not quite at 2019, just give me the correct story or let me understand, and we can build something around that. That's good. So always like in-place cash flow.
Got it.
But I will say, if with the right relationship, we might, stretch on that a little bit. So.
Got it.
I will say a lot of the regulators are wanting you to do a mortgageability test on your portfolio, right? If you have stuff
Your
maturing.
takeout financing.
Yeah, if you have to, take out financing. If you have loans maturing in the next 24 months, do it, 10-year treasuries and put a fairly significant spread on it, 30-year AM, and
So if
tell
you're
us what
doing
you cash for.
if you're doing a 5-year loan and you think rates based on futures is going to be X, you have to underwrite to that and say, okay, in normal times, which I'm not sure what those are lately, but in normal times, would you have an opportunity for Scott to take me out or vice versa, or another bank to take you out? And the regulators and auditors are focused on that.
Got it.
As they should be.
Yeah.
Okay, we got 5 minutes till the Fed announcement. What is it?
25.
Bruce?
25.
Jim?
You know,
We have 5 minutes, Jim.
dude, I'd like to vote, but I don't know that anybody freaking knows.
No, you have
And,
to do something.
Well, if I'm putting a G on it, I'll go 25.
Okay.
And I'm
reluctantly.
going to agree that 25 basis points.
All right, so, and I'm gonna be the contrarian and say nothing, just to
Okay.
have a difference of opinion.
I think there's odds on for that.
There's 13, according to the CME group, currently there's 16.6% probability of
Don't tell
of
me
no
that. I
hike.
don't have my FanDuel.
So-
Think what the stock market will do if there's no
So we're down.
rate hike.
Oh my God. Well, see, and we were talking about that because what's the message that no hike sends?
It says that we're over.
What's
That
the
we got a problem.
message? 50
Well, no,
basis
it'll
points.
say that we're over and we're not doing it. And what Yellen said yesterday about essentially we're going to guarantee all deposits.
Right? How long is that good for?
It's over. Inflation is contained,
Oh, yeah.
which it's not.
Right.
But that's a message that zero would send.
Oh, I think that the message that zero sends is like, we got a problem
Yeah.
and we can't push rates anymore. And
which
that-
we do. They're between a rock and a hard place.
Oh, no, for sure. I don't want to be J-Pal right now.
I think there's going to be a lot of messaging over the next 2 weeks.
There's good, yes, yes, because
And
they've been in the blackout
I'm pretty
period
sure
for 10
there is
days.
somebody on the grassy knoll, so
Yep.
I don't know.
Okay, we got just a couple minutes. Any questions before we wrap up?
Maybe in the front row?
Yeah.
I have a question. Is there anything, a strong Canadian group that is interested in speaking to you guys, that is interested in acquiring assets in the U.S., is there anything, do you have any advice that we should take into consideration for presenting ourselves to you? We've just found, when you have strong sponsorship on the Canadian side, the U.S. banks look at us still very differently. And I've heard you guys all say relationships are important, and you guys, with time, decide who to, work with long term, but just.
So I have a current relationship that,
You want to repeat the question?
I'm sorry, and I don't, so his dilemma or his opportunity, he's a strong Canadian company that's looking to do stuff in the U.S., and I'm assuming to acquire assets, and you'd like to leverage your equity. We actually deal with somebody that part of their ownership was in Canada, in the U.S., and we were looking at some stuff, and we did the relationship in the past because of the U.S. connection. So I don't know if you don't need to JV with somebody that has a track record like a Vision. I'm not telling you to do that. That is not a disclosure. Yeah.
Paying for it just to start establishing.
Right. No, and I understand that, but one of the things that you might have to do with, on top of that, is to have those assets paid for in cash and pledged and or additional deposits and or cash. You have to have assets of like nature in excess of the loan, or the bankers really, they don't want to go through the brain damage of going to look and build that relationship in Canada when we have a plethora of opportunities already in the U.S. So I would say establish banking relationships, put in deposits, get that flowing, and then pledge some assets that are unencumbered.
There's also a lot of other lenders who aren't banks and have a slightly different set of regulations they have to operate under.
Funds would be good.
Yeah, and I would say like Wells is obviously in Canada, right? So I don't know how your current hotels are financed up there, but if you had a relationship with Wells already up there, that's certainly helpful to, that's a
Very good point.
relationship
Yeah,
established
great point.
within the bank.
Gets back to relationship.
Yeah.
Any other questions? Nobody? Okay.
So what'd the Fed do?
We got I think I'm waiting for the website to reload. I think we got a minute or two, or less than a minute before they should actually.
I thought we were going to put this on the big screen, no?
Where's the big screen?
Well, there's one over there.
They don't need to see our pictures.
Yeah, I don't know. I didn't bring a PowerPoint, so.
Well, I'm not an AV guy, so.
Yeah, me either. All right. Well, everybody, thank you very much for coming. Let's give a hand for our
Thank you,
panelists.
guys.
And I'm still waiting for the rate decision.
Everybody's on their phones right
I know, it's like this collective groan.
now. Yeah.
Everybody's looking at it.